All right, as we mentioned, stocks sliding today with the latest bout of volatility triggered by Donald Trump again. This time it's his attack on Federal Reserve Chair Jerome Powell and his demand for an immediate interest rate cut. My next guest remains positive on equities despite that. Let's find out why. John Stoltzfus is Chief Investment Strategist at Oppenheimer Asset Management. Thanks for joining us today.
Thank you for having me, Carola.
Why do you remain positive in these difficult times?
Well, I'd say, for one thing, I've been in this business for over 41 years. And so I've been through every boom, bust, and recovery cycle since 1983. While past performance is no guarantee of future results, generally these crisis points, when looked back at in hindsight, are recognized as probably fabulous times to pick up some babies that get thrown out with the bathwater in market downdrafts. Because usually when crisis occurs or there's something like this tariffs, it's not yet a crisis, but it's projected as a crisis if it's really put in place and lasts for a long period, we would have to expect that, that cooler heads will prevail. For the simple reason that the alternative to cooler heads prevailing wouldn't benefit anybody. It doesn't matter whether they're an exporter or an importer, or if they're the U.S. or a developed international market or an emerging market. This needs to be resolved, and likely with a fairer landscape developing for all involved.
Okay, let's talk about what you see that you like. First of all, I'm wondering whether with the downward slide, you think the stocks or the sectors you like have bottomed out?
Yeah, not yet. I think that we're close to it, but I think that what we have is we still have a high level of uncertainty related to when are agreements going to happen? Are they going to happen? Will the Trump administration remain absolutely locked into this? The idea that tariffs are the way to go. We don't think that's likely to develop. When it comes to what we like some of the sectors that have been most beaten up. And they would include information technology, communication services, industrials, consumer discretionary, and financials as being sectors that have really been heavily hit within the sell-off, where we're seeing as effectively value outperform growth, and cyclicals in general having a pretty tough stance versus defensives. And we think a lot of that is typical of an environment like this. If anything, we think the market's response at this time is not a tantrum. A tantrum. It is essentially it's exhibiting serious concern about the effects of a tariff war developing that would become a long-term thing. We believe there is likely, as a result of trade practices over the last 80, 70, 60, 50, 40, 30, 20, 10, even 5 years, we believe there's probably overcapacity in manufacturing in many countries around the world that have manufacturing designed to have as its destination the U.S., which is the consumer nation. If anything, we're no longer the manufacturing nation we once were. It's not that we don't have manufacturing, it's just not to the extent or the breadth that some other countries have today. So we look at it, we effectively think, you want a good diversified portfolio at this point, except for more experienced investors. You probably want to stick to large cap, high quality, but within those sectors that I mentioned, because they've been hit very hard at points like this in the market, the negative pitch book, what we like to say, that many trading rooms and trading floors are operating on, effectively project negatively into infinity the current situation. And generally speaking, nothing is permanent. And especially these negative situations that develop, usually you find solutions because it's impractical to do nothing.
John, you compare the tech industry and what it's going through now to the auto industry of the early 20th century. Can you explain what you're seeing?
Sure. Well, for instance, before the automobile, before Henry Ford, before he mechanized the assembly plant of the auto factory, it made a big difference when he did automate it. What happened is he brought down the unit price, increased unit quality, affordability for many people, and it changed the way people lived. Technology today is very different from where it was just as recently as the tech bubble. It was relatively new in terms of the consumer. Business had technology involved for quite a few years. But what we've seen over the course of the last 20, 30 years has been a remarkable acceleration where today technology is deeply embedded in the lives of both business as well as the consumer. And while a digitalized society has certain challenges related to privacy, cybersecurity, et cetera, it also affords many efficiencies for corporations as well as for their consumers who interact with those corporations that enables a better communication, better ability to adapt to changes. And that's what we believe we have here. And the other thing is we're all on the upgrade cycle. I think it was about probably 4 months ago that one of the premier names in cell phone technology announced that it would only be the current year and the year ahead that would have the chip in their cell phones that would be able to take advantage of the AI program that they were planning to implement. Right away, that meant everything manufactured before that was essentially an anachronism. So if you wanted to keep up with the latest, and not just in style, but rather for practical purposes with your phone, you really needed to upgrade your phone to one of two models. The current model or the new model. And now it's the next three models. It's now three models of that company. You have to forgive me. It's the first time we've worked together. I manage money for Oppenheimer, so they don't like it if I talk about individual companies. I can talk sectors, growth versus value, market capitalizations, and a wide variety of economic and fundamentals for equities, but not specific companies. That's why I had to present that company the way I did.
No worries. We appreciate you joining us on the program with the insight that you have, John. Thanks for your time today.